right, good morning. Hopefully you're all enjoying the process. If you're new to this morning, again, the process got you into big things like gold in February of last year, silver in May of last year, oil and gas stocks February 2nd of this year. And again, today's March 3rd. So if you have friends or you come from that environment, and we feel for you. That's why we created our community. I mean, it's no way to live your market life. Watching CNBC, I mean, come on. If you think that what should occur would have happened 24 hours ago should have kept happening intraday yesterday, which it didn't, and then shouldn't happen today, which it is, you got it totally bass-ackwards, baby. I mean, just accept one thing. We can all be better versions of our former selves. Do yourself a favor, and if you believe in AI, let that signal, the foundational component, the math embedded, the fractal dimensions embedded in my signaling process, will provide you the freedom of humility and not having to be certain. If you need like the Telecom Toms or Micro Marcos guys from JP Morgan to give you certainty about the future, the top 10 things are going to happen, and then highlight the 2 that do, it's so bass-ackwards. Okay? Just stay with the process. Okay. This morning, the process last week, by the way, on the dollar had us cover it. I know that wasn't random. It got me out of Swiss francs on the same side of that because that was my only currency position. So all this happened last week. Again, it's this week. It's March the 3rd. Okay. Let's get up and get at it. Dollar up, oil up. Those correlations are actually materializing at a faster pace, which doesn't have to be quad 3. It just is quad 3. So again, when you think about what does quad 3 mean, that means that the inflation component that we had going down, really for the last 5 or 6 months, stops going down. That's what March is. Okay, March is a quad 3. So again, you get paid to be overweight oil and energy-related stocks, and obviously that's on your page. In as much as managing this newfound interest rate risks. Now, a tourist's going to say, well, if Hedgeye is right again on inflation and it stops going down, then bond yields must go up. Nah, not when growth is slowing, it doesn't. So again, today would be a good day if you haven't bought it yet. I just started buying it for real yesterday. The Tizzle. Oh, yeah. The TLT. Oh, yeah. What a call. Here we go. It's not a call. Again, it's executing on the process at the top end of the risk range, and anything would be a seller. In the case of bond yields, you're a buyer of bonds. When bond yields are at the top end of the risk range, please mind your gaps, mind your risk ranges, and enjoy the day. Bennett, good morning. By the way, I'm handing it off to RPK today, so people don't have to listen to me rant any further, but I do try to give them 2 or 3 minutes and see if you guys can beat that.
RPK, Keith, I mean, just the process, man. 2 names, Keith, that fly under the radar for us. First, Turning Point Brands, TPB. Got smoked yesterday. Their core portfolio, zigzag, rolling papers, cannabis cones, wraps, accessories, Stoker's, moist snuff, and loose leaf chewing tobacco, and then their modern oral nicotine pouch like Free and ALP, ALP. The stock got eviscerated, like I said, on the back of a weak Q1 EBITDA guide that reflects a deliberate upfront investment in sales and marketing for their modern oral nicotine segment ahead of ALP brick and mortar launching in the second quarter. I view this as that rather than operational deterioration. In fact, as Daniel knows, growth in nicotine pouches is only accelerating into 2026 with the monthly scanner data for Velo continuing to rise from 6.8% year over year in November to 7.2% by January. Zyn actually going from negative, mainly flat, to almost 2% growth year over year in the same frame. The company reported a 266% growth year over year in modern oral nicotine pouch sales. It represents 44 million of sales today. They believe it is a $230 million opportunity, more than 5x what it is today. The company is prioritizing growth investments over near-term profitability. This is duration that we've communicated for the longer-term investor. And then on BlackRock Coffee Bar, BRCB, they report tonight. Little small cap company in the right category in beverages within the restaurant space in the right region of the country, the Southwest region. This is a 20% unit grower. They IPO'd back in September. This is their second quarter as a public company. The data normalizing a touch, but they have a lockup that expires March 10th in just about a week here, meaning shares become eligible starting on the 11th. Just 8 days. No new money is coming into this thing. The street viewed CEO Mark Davis, former Panera product in a positive light. Last quarter, I'll report back anything incremental from that. And then finally, Keith, March 3rd, the big arch comes nationwide to all McDonald's starting today. That's it.
Yeah, big Arch, Big Mac, Big Signal. McDonald's is a buy. Don't really care about BlackRock. We're wasting our time on something that we don't have a position in, by the way. We can talk about it after the quarter, but thank you for that, Bielsi. I got you're moving on up here still on signal strength. So you saw one name in particular, European name, move into the top 30 yesterday.
Unilever?
Yeah, oh yeah. You read your email. United Airlines. This is not the ticker. It's U. Take out the A. It's UL. Okay, Unilever. Who in their hot mess of owning software and shitcoin stocks is talking about buying what could really clean up your portfolio this morning? Unilever. All right, come on. So that's put that in the top 5 most actionable before Bielsi talks you out of it. I don't think he will, but go ahead.
Definitely not. This one I think is going to get re-rated as people just get more comfortable with the growth formula here. And then we met the CEO for the first time at CAGNY. I think it was the first meeting for a lot of U.S. investors, and he is taking charge, and he's really firing up that company, changing the culture. He's let go a lot of people. He told the top 200 managers that many of them aren't going to be there next year if they meet their performance requirements. And he changed the incentive structure too. Instead of just giving a typical bonus to people, like they actually had to have exceptional performance, and then they got a bigger bonus, but most people didn't. So it's quite a culture shock for a European company, if you can picture that, Keith.
Yeah, I mean, you do your 30-year cash flow analysis on your latest software implosion, or do it on Unilever. I'll go with soap over software. Okay, Mongo, Donkey Boy, whatever you want to call it, MDB is down like 25% this morning, for example. Systematically, what's happening, BLC, is of course that these companies in software are showing rate of change slowdowns. It's not some valuation trade. So again, that's what the bullshit people would be pushed on CNBC while they're getting Salesforce.com commercials spit at them. But UL, a stock that is not widely held, certainly by U.S. hedge fund managers. Let's put that right at the top of the list today. What else you got?
So I was going to hit real quick on Shark Ninja SN. It's my top pick. They filed their 10K, their first 10K yesterday. That's why I'm highlighting it after the close. So becoming a domestic filer is just another step in their maturation, and also it will move them closer to being added to the S&P indices. I will note the company's auditors identified a critical audit matter relating to variable consideration for non-standard markdowns and allowances. Basically, the auditors had to audit their estimations, which is what all auditing is, right? There's so many projections. I will put this in context, though. Critical audit matters are no longer uncommon. Since 2020, the SEC sort of changed so what is required to be noted by the auditors. I will note, like Coca-Cola, Walmart, in their last 10Ks also had critical audit matters identified. It just means what the auditors sort of flagged to the audit committee. So I don't put anything into that. I just want to highlight that. And why I think it matters is what wasn't a critical audit matter and what wasn't was the acquisition cost of goods acquired from JS Global, its former parent company that's listed in Hong Kong. That was the innuendo, or really the heart of the short report, and that wasn't flagged. And that's, I think, what's key is not that they had one, but what it wasn't. And I think that's a critical point of just moving past that whole sort of short attack. I think the stock has, but just wanted to put the final nail in the coffin.
The coffin, you can't, the Undertaker keeps coming out of that coffin with the modern day information flow. People think newsletters and tweeters are all experts. So again, people will come out with short reports and whatnot. What you'll find is that most of these things, from Hindenburg on down to wherever, Citron, like they don't have a process. They're selling you, they're buying puts before they put positions on. I'm not saying those two did in particular. And by the way, I'm not saying that they don't. I'm not making accusations specifically out of anybody, because that is legal exposure I don't need in my life. But the fact of the matter is that they don't have the Hedgeye process for short selling. Okay. Hedgeye process is systematic. It's rules based. You have me sitting on top of the whole thing to make sure that the boys and girls at Hedgeye execute on it both deliberately and consistently. All right. It's just flipping it. RPK, by the way, you can take over the you've done this job for I don't want to tell people how many years. Maybe you'll admit it.
Yeah, thanks, that's kind.
But for those of you that are new, again, today's free week, so a part of free week. So RPK is one of the portfolio managers, former Hedgeye client, former everything, from analyst at Steve Cohen's hedge fund to being the portfolio manager at multiple places. So again, he runs what we call the HAM, Hedgeye Asset Management. Two of our ETFs currently, and that's who he is, and he's better at running the call than me. So our faithful Hedgeye community said, Keith, please, during free week, let everyone know that RPK is on our team. So there you go.
Oh, wow. Thanks, man. I don't think I run the call better than you, but I appreciate the shout out. All right. Awesome. Cool. Well, then with that, let's keep it moving. I think, Boss, you got anything else, or are we moving on?
I'm good. You can go to Sean.
All right. Very good. Jenk, Sean?
Yeah, I am dialing in from good old foggy London town. Flew overnight here to meet with customers. So always looking forward to these weeks. But
you flew to
last
London?
Earnings season. What's up?
You went to London?
Yeah, I'm in London right now, Keith.
Are you fucking out of your mind, man?
Why? What do you mean? We got clients to meet. We got business to do. Come on.
Oh my God, that's okay.
Hey, we can't live in fear, or at least I'm not going to. I'm not about to start today. But anyway, hitting on two of my remaining earnings here, which is Lottomatica and Viking. I'll hit on Lottomatica first, since they reported early this morning. It was nice to actually be on European time while a European company reported earnings. But the quarter in a nutshell: beat the quarter, guided above the street for 26, which is really what most people were focused on, is what that guide's going to be. Like most gaming companies, but Lottomatica in particular, we have all the main KPI once the quarter arrives, so there's not a huge amount of volatility. It's certainly not on the top line. So top line came in nicely in line, but the margins were better, which drove obviously the EBITDA beat. But the guide did have really solid implications for how the core business is trending in the year to date, and really the outlook. They don't guide assuming they're going to gain share. But what they did disclose was really revealing, which is that outside of the acquisition they did last year, which does have some impact to market share, blended market share, at least initially as you're integrating a new company, the organic sort of share X that acquisition took a massive step in the right direction, continued to accelerate. The big news, though, in addition to the guidance being better than expected, is the buyback authorization that they did step up. Essentially, they're asking for authorization from the board to take down another 12.5% of the float between now and year end 27. What that will mean is essentially in 2.5 years since they started a buyback program, they're going to take down 20% of the publicly available float. And so with growth ticking higher, earnings volatility materially lower than the rest of the gaming industry, we continue to like the stock. Shares are reacting favorably finally in this name, in a sea of red with GLL. But we see a lot more upside, certainly as more people come around to what we think is one of the better algorithms, shareholder algorithms that is in gaming. So that is it on Lottomatica. And then for Viking, we just got the press release a little bit ago, going through all the details. They give us press release, and then they give us a very detailed presentation that I got literally 3 minutes ago. But the big takeaway here is massive beat across the board. Revenues driven by a jump in capacity growth, so they added more ships year over year, but yield growth also accelerated, so double whammy. Revenue top line growth accelerated to 28% year over year. That's up from the mid-20s in the prior quarter. And adjusted EBITDA just blew the absolute doors off of consensus and my numbers, which were well above consensus, and surged up 50% year over year. So you're starting to finally see, not finally, I should say, over the last couple of quarters, you've seen very nice operating leverage. But consistent with the recent theme with this one is EBITDA and EPS massively outpacing that of the top line. And the big important factor here is obviously book position. How are they positioned into 26? We had the call that they were going to be putting up an acceleration with respect to pricing. We got that. So pricing on book positions so far, they're 86% sold out for the year ahead, by the way. Pricing accelerated to 6% from 5.5%, and that's entirely driven by a nice step up in their ocean inventory, which had been lagging River. River did actually slow by 20 bips, but ocean accelerated by the 100. Therefore, you get the nice blended acceleration. Call is just starting, so I'm going to hit that in a minute here. But RPK, happy to take any questions. Obviously, with all the geopolitical rumblings around the market, oil, ramping and stuff. There's other factors at play here, but from a core fundamental perspective, I think it's nicely intact. The big risk, I think, outside of fuel is a risk, but it's decidedly less of a risk for this one than it is for the big three. Yeah. And I hit on that yesterday. But the big risk for this one is, if this war continues, what's the risk on cancellations? And I think historically what we've seen is that when there's conflict in the Middle East, the impact to bookings, the impact to yield growth, and ultimately the impact to stocks is fairly short-lived. Not saying that that's what is going to be the exact case this time, but when we have seen, attacks and impacts in Europe, i.e., the terrorist attack in Paris or in Barcelona in 2015, and then in 2017, that did have a big impact to yield growth. So obviously, I'm not anticipating what's to come. Just saying that typically those are the kind of impacts that we do see when regionally, when it's a little closer to home, Western Europe, or God forbid anywhere closer to the U.S. Less so when it's in the Middle East. But that's just sort of the historical precedent. But anyway, got the call today. If you have any questions, I'm happy to take them.
No, that's good. I was going to ask the fuel question. I know you touched on it a little bit yesterday, but obviously oil prices are up even more. You've had, diesel is going to start to be a concern. I think pricing there. So I just kind of, that was one. I mean, look, hey, right, a lot of unknowns. As I talked about this morning, we live in a big, complex, multivariate system. There's no.
Yeah, I love that tweet that you put out. Yeah, I saw that.
I mean, it's so in the signal we trust. Like as long as accelerating pricing, 86% booked. That sounds great. Like, so if this ends relatively quickly, then it's going to be fine, right? Like, it's only if it has more economic impact that it starts to show up in some.
No, absolutely. I mean, that's the thing to consider with this one, right? And for 2027, they're already probably 30 to 40% booked. So, I mean, the cancellation risk is really the big thing here. I mean, financially, yes, fuel would have an impact, but it's 3% of revenues. 4.5% of OpEx. Like it's double, triple that for peers. Yes, some of their peers do hedge, and yes, Viking has more Europe exposure, i.e., Americans traveling to Europe or wealthy Brits traveling to the Danube or going to the Mediterranean. That's the risk, and obviously, I'm at least humble enough to admit I have no idea where that risk is headed in the next 24 hours or 24.
Nobody
minutes.
Else does either, so it's. No matter what they say. All right.
Exactly.
Fair enough, man. All right. Good. Safe travels.
Thank you.
All right. See you, buddy. Brian, you on, man?
Yeah, good morning.
Morning.
So we had a couple of earnings this morning. The first is Best Buy. This is an active long for us. The stock is ripping on the numbers. To be clear, they were ugly numbers. I mean, the company missed comp. They put up a negative 0.8. The street was looking for positive like 0.5. So it wasn't a huge miss. But they beat on EPS, which was due entirely to cost cutting. SG&A came in lower, and the share count came in lower. So not a very high quality beat, but a beat nonetheless. And the pod shops here were definitely positioned for a miss. I heard numbers as much as the company comping down 6% because that's what the credit card data was telling us. And lo and behold, they came in and they beat that. So the stock is up 11 on this. Generally speaking, the consumer product cycle is better than I think people are really looking at. The big risk is that you have this chip shortage, which is impacting laptops and mobile phones. So that accounts for about half of Best Buy's business. On the flip side of that, you get the part of the business that's linked to home turnover, which is the other half of the business. That's, I think, inflecting. You get these two opposing forces here, which are really offsetting one another. So we'll see how Best Buy does here today. I'll have to listen to the call as well and see what the company says about what's going on a category basis. I'm not married to this stock by any stretch. It doesn't have signal strength. Maybe it will after this print.
It's got some work to do.
Yeah,
Yeah.
it definitely does. But the other name I wanted to touch on is ON. This stock, this is an active short for us, and the stock is down 11 on the print, so I'm happy about that. The company beat the quarter. It always beats the quarter. It's what it does. But you saw a top line or a pod one deceleration. So revenue still looks really good. It looks healthy. I mean, the company is clocking in at around a $3 billion revenue number for the full year, but they guided for the upcoming year to be a deceleration down to growth of 23%. Still a respectable growth number, but a deceleration is a deceleration.
Yeah.
I mean, it is what it is. And when you're a growth stock and when you have so much priced in to become the next Nike, you can't put up a deceleration like that. The number I have the biggest problem with is the gross margin. This company is putting up a gross margin of 63%. Its peers are operating at about 50, and it's doing 63. So the punchline on this one, like last quarter, let's see what the company says on the call this quarter. But last quarter, they talked about their quote unquote full price model 13 times. That was the count, the number of times they mentioned that on the conference call. And that's great. That's fine and good. But if they're going to hit their plan and become a $5 billion brand over the course of 3 years, there's no way they could still sell at full price.
Is that a function of like their distribution points now, like the mix of distribution?
Yeah, I think it's really, that's a good question, but I think it's more so a function of the fact that the brand is just white hot.
Yeah.
Like everyone, like I'm staring at my Zoom screen right now is, 30 people, and probably 20 of them have a pair of Ons. It's just a white hot brand right now, and whenever a brand is hot, it sells at full price. That's just how retail works.
Yeah.
And you're going to have to start discounting product. You're going to have to be more competitive. And let's talk about the competition for a minute. This company grew up and became hot when Nike was hemorrhaging $5 billion in sales annually. So that went like directly to three brands, Hoka, which is owned by Deckers, On, and Adidas. All those brands, they benefited from Nike hemorrhaging sales. While Nike is no longer hemorrhaging $5 billion in sales, I think Nike in the upcoming quarter that it reports in about a month is going to surprise on the upside with top line. That's where it's going to beat. So with Nike coming back, even if Nike is buying back its market share, the fact is it's still making it a very difficult environment for companies like On to put up bigger growth numbers. And that's what I think we're seeing here with the company's guide, with a sharp deceleration in top line growth.
For anyone who's joining us on the free week here, I am not one of the people who has a pair of these, because I am probably one of the least hip people on this call. But no, I mean, I just wondered if, like, if it's that hot, right, you're going to get a lot of DTC. That's all going to be at higher margin. If this has to be the next Nike, you got to obviously get your distribution points, right? Like much more widespread. You're not going to be able to keep that gross margin level to do that. And if I follow, I mean, It's not on signal strength right now, but if I think of your current sort of thesis setup, Nike's the next Nike.
You're right. I don't think Nike is going to be. It's never going to be the Nike of old. And I have bears who tell me Nike will never achieve its former glory. In order for the stock to work up to $100, it doesn't need to achieve former glory. Former glory is a $200 stock.
Yeah.
Nike, the fact is, it is winning right now. It's putting out a new innovation like every 3 weeks. And under the former CEO, John Donahoe, who was terrible, and we called for him to be fired, they were putting out a new innovation every 52 weeks. So they've just, you just never want to bet against Nike when it's spending a lot of capital on product. And that's what it's doing right now. So that makes it really difficult for Hoka, for Adidas, for Puma, for Skechers, for Saucony. I mean, up and down. Everyone's cost of growth is going higher. And when cost of growth goes higher, margins come down or revenue decelerates. Both of those make the stocks go down.
All right. Excellent. Anything else this morning?
That's it for me.
All right. Thanks, buddy. Let's keep moving. Let's go to Tom. You on?
Yeah, I'm here. Sorry, I'm having a little sound issue with the main.
It's all right. Coming in loud and clear.
All right, so I guess I'll start with surgery, SGRY.
Yeah, let's start there. Way to go.
It's well, it's interesting because the thesis that sits around surgery also should be impacting tenant health as well. THC also a short.
Had that thought last night. Yeah, when I was reading this.
So we'll see, right? So the big issue that came through, what we've been flagging is sort of a softness in volume. They clearly have some other issues going on. I think the assumption going into this year has been there are all these high acuity surgical cases sitting inside of acute care hospitals, medical surgical hospitals. And because CMS has loosened the guidelines, now you can take these cases out into these ASCs where the staff, is well trained. It's, they can turn the room really quickly. The surgeon has an easier time and it's more pleasant for the patient, and they get discharged and they go home and it's all great. We don't open them up to hospital acquired infection and just the stress of being in one of these big, multi-specialty acute care centers. And they're, because these are higher acuity, they're higher revenue, higher margin, and boy, won't this be great. And I think the real issue becomes, well, if I'm on a large acute care hospital system and I have high margin cases that are potentially going to leave because my surgeon prefers, an ASC, I'm going to try to keep that volume. That referral becomes very dear to me, and I'm going to do everything to keep it. I think that's part of what's happening, but I'm also seeing in the data, and part of why we're short surgery and sort of hospitals generally, we're seeing just volume be soft, right? So the ambulatory care type time series all look negative, and I think that showed up pretty clearly here. I'll update the data product tracker. We have the HCM forecast, where we use all that macro data and some of the special stuff we've gathered to get to same facility growth, et cetera. So I'll have that updated and published tomorrow. Anyway, so that all to say that they're guiding, the street was at 582, 585 for EBITDA. And this year they're cutting that all the way to 530. And I think there's probably downside to that. The high, very, very high incremental margin. And if they have a referral problem, or they have to rationalize their footprint, or whatever that issue is, it's just the degree of difficulty. They don't own anything, right? Like they don't own they service these surgeons. The surgeons may or may not have an equity interest in the box. They have other people to contend with, including a large acute care system or more ASC capacity coming online that becomes competitive. So I think surgery's got more issues than just today. And I do think this will bleed over into HCA to a lesser extent, tenant to a greater extent. And then the other name from yesterday was RadNet RDNT. This has been a kind of a controversial long for us. It was off of signal strength for a while. I think it's going to make it back onto signal strength in about a week, maybe a week and a half, depending on if it can hold this price. Big top line beat. That was what we were expecting. Less flow through to the EBITDA. That was a little concerning. They made a small acquisition to tuck into Deep Health. The commentary around Deep Health and their AI strategy was better than I'm looking for. I'm not really looking for it to do too much. And then in terms of the top line guidance, well ahead, EBITDA guidance slightly ahead. So there's an issue here where they're overspending or spending more than I would have expected, like the incremental margin drop through for an incremental advanced imaging case, high value, high revenue, high margin. It should be higher. So they're soaking it up in some of this AI investment. I would love it if they would just deploy that internally for their own purposes. They're spending a lot of time and effort to build the better mousetrap. The one question that came up on the call, which I think is relevant to you and to everybody else sort of looking at this, is that there was a question about non-healthcare companies looking to disrupt imaging. And if that's actually a thesis out there, I think people really need to think through how guidelines get set, how managed care pays for or doesn't pay for something, and how Medicare decides to pay for or not pay for something. The issue here is not that there's a dearth of AI imaging tools for radiology. The problem is that the guidelines really define how that how it gets deployed, how it gets paid for.
Yeah, I mean, maybe I'm a moron. How would they get a hold of how would they have access to like the data set to even train it accurately without, I mean, this is all HIPAA covered stuff. You can't just again, you can't just scrape the web.
There's a host of it. Listen, I'm just calling it out because there's a large short interest. I think a lot of that short interest hovers around this AI question generally. Emily's going to talk about it this week. I'm really interested to hear this because I do think fundamentally, again, are the radiologists really going to write themselves out of business? I don't think so. Is there, who owns the liability for reading?
Yeah, I think that's the biggest question. I mean, that's a good segue to Emily too, because I'm stuck on that like you're gonna have to have someone who says, even if the AI does 99% of it, you still have to have a person there who has the malpractice insurance, who's like, yes, that we're good with that. Right? I mean, am I wrong?
Well, I mean, I think you
go
could.
Ahead, Tom.
Well, I'll look forward to Emily talking about this, but I do think that issue of consumerism, self-referral, and are you going to listen to the bot, right? Like that, there's a checkbox you could probably put in place and say, I'm going to get GLP-1 from this weird vendor, right? And because it's essentially put me through an algorithm that says I'm fat enough and I should, if I want to take it, right? Assume the risk, right? You're acknowledging that you're putting this risk, that you're being told something that may or may not work out to the best. I think as you get into these higher clinical use cases, that liability definitely gets way squishier. But do you just acknowledge the liability and move on? For the consumer, I think with this, it's much more. There's other layers of how that liability and what standard of care is really, I think, the core question. But that's let Emily talk about this on Thursday when
do you have anything else this morning, or is it
no? Just rad that again. I think it's going to be on signal strength in about a week and a half, 2 weeks. Surgery, I still love the short side. That's it.
Yeah, I mean, Keith will have to weigh in. I mean, volume's going up, stock going up. Yeah, we'll see. Yeah, maybe it gets there faster. I don't know.
No, I'll put a flag in the sand on that one.
All right, excellent, very good. Emily.
Hey, good morning. The call's tomorrow at 10, not Thursday. But the question of liability is one I am going to talk about. MIT did a great paper on the 5 heavy lifts of AI in healthcare, which is very helpful. And the data aggregation and integration, what you would train a model on is a huge problem. And even if whether radiology, whatever, but if you think about how much bad research, scientific research there is out there. I mean, like take Alzheimer's, right? You've got a gazillion papers saying that, it's this amyloid beta thesis, and if we just did these things, we'd cure Alzheimer's. Well, that was just not true. It turns out it was a very corrupt system that produced that research. And those examples of that are everywhere in healthcare. And so that's a challenge for sure. HIPAA is another challenge. I envision that there is probably scenarios where individuals get treatment from AI, but they waive their liability. I don't know that states are going to go for
Yeah.
that, but I think that is probably the most possible scenario because liability is and that extends beyond in other domains. There's a New York state law being introduced that would prohibit the use of AI in providing legal advice. So for the same reasons, who do you sue if you get it wrong?
Right.
And then we have the Supreme Court deciding yesterday, maybe Paul will talk about this, that they're not going to take up the case of AI and copyright law, which, just adds to it. At the end of the day, it's a machine. It's zeros and ones. and you got to keep that in mind. But anyway, tomorrow at 10, we've got some good stuff, including Mark Andreessen explaining why he endorsed Donald Trump. And I want to tell you, Dario Amodei, he's got a real Bill Gates vibe going. So we're going to include him too. And that's it.
All right. Boy, I don't know if that's the Bill Gates vibe thing. I don't know what that, I don't know if that's,
well,
is
you
that
know how
all the
Bill
implications?
Gates, for throughout the 90s, well, throughout 2000, 2010, Bill Gates would, when he was working with philanthropy, he'd get on TV and talk about, pandemics, they're going to kill you, we're all going to die. If it weren't for my philanthropy, then, we aren't going to die because of all these wonderful things I'm doing. Just take this shot or take this pill, whatever. And we discovered well, most of us already knew, but
Well, I mean, these are like, okay, now I get what you're saying. Yes, many of these people have like messianic complexes, where they have to weigh in to save the world, right?
yes, that's what's going on here.
Yeah.
Exactly.
All right. Fair enough. Good. Anything else this morning? You good?
No, that's it.
All right. All right. I gotta look up that MIT paper. That sounds fascinating.
Yeah, I'll send it to you.
All right. Thank you. Excellent. Let's keep it moving. Steiner on or Matt?
Hey, RPK. Yeah, I know Josh this week. Him and Drago are both in London with Jenks as well, doing some marketing. So you'll have me for the next couple of days. But I just wanted to briefly, I mean, Keith's early look this morning kind of goes with what I was gonna talk about. Yesterday, Jamie Dimon and JP Morgan had the LevFin conference down in Miami, and there was an interview that had some headlines, kind of snippets taken out of it, like the inflation being the skunk at the party, a comment, and also that there's a lot of exuberance in markets, and directionally he's right in what he's saying, but part of what Keith wrote in the early look this morning is just how people kind of will take headlines and sort of use it as their own. And for a bank like JP Morgan and a guy like Jamie Dimon, whose job is basically to not be wrong, whereas I think at Hedgeye our job is more to be right. And just kind of having everything come full circle. Christian Drake wrote a really good note yesterday that we published to Macro. That's definitely worth flagging and definitely worth taking a look at. And kind of the takeaway is just that, there's obviously a bunch of uncertainty, especially with, the war going on in the Middle East. But, there's a lot of other factors that when combined together can actually, make you understand the situation a lot better. And the way he wrote it as macro awareness is uncertainty agnostic, and curated quant textualization remains additive, which I think is super true, because, he went through the comp setup that we have over the next couple of months, comping Liberation Day last year, like ISM data, other data that's sort of supporting, post shutdown labor rebound. And then obviously the the tax refunds that we've been calling out ever since the One Big Beautiful Bill was announced, and how that's going to, have a positive sort of tailwind for consumption. So I thought that was kind of full circle. And then I was reading Keith's early look this morning and thought, yeah, there's a couple good takeaways from there too.
No, it's good. Yeah, no, that's a good. I was thinking back to a Buffett quote that went around back in, or like post the '08 crisis, which was like, if you drive around at 100 miles per hour with a spike sticking out of the steering wheel and you hit a pothole, what killed you? You know what I mean? Like, it's sort of like you don't really know like what ends up happening. Like, it could be a leverage issue because of the liquidity? Is it because oil prices go up because of the war? Like, it's a lot of things that can end up happening. But to your point, like, the setup is still the setup. If this, unless we have a prolonged impact on all of these things, it's still kind of the same outlook, right? Is that?
Yeah, I mean, that's the risk, right? Is that there is a prolonged impact, and the oil prices rising is a small portion of inflation, but as if it continues for longer, then obviously there's a risk there. But that's not the only thing that's going on, I guess.
Exactly. Yeah. That's what. Yeah, that's good. Yeah, we don't know exactly where we're going, but we have a way to get there. So
exactly. Yeah, that's a good process quote for all of our new people this week paying attention. And then briefly, I just wanted to also hit on Circle. I know you and Josh kind of went back and forth on this on Friday, but this morning we moved it off of our best idea shortlist. Josh kind of ran through the quarter. They reported last week on Wednesday, but the main thing was USDC in circulation up 72% year over year to 75 billion. And there is still kind of a debate on stablecoin yields. Funny enough, Jamie Dimon also spoke about this too, just about like if you're gonna, because that's pretty much how they make money, right? Every USDC in circulation is backed pretty much 1-to-1 by either cash or short-term treasuries, and so the more USDC that's issued, the more revenue they generate. But Jamie Dimon was basically saying, if you're gonna act like a bank, you should be regulated like a bank too. So there is a bit of a debate on that, but as of right now, I mean, they're putting up good numbers, and the signal has also flipped from bearish to bullish. It was bearish, went to neutral, and now it's bullish. So we've taken it off of our best idea short list and added it to our long bench.
Ooh, that's like a rare showing of his cards from Jamie. He doesn't like this because these guys could potentially be right at a profit pool that these big banks have.
Mm-hmm. Yep, exactly. So just gonna kind of continue to monitor that situation along with all the other situation monitoring that we've been doing.
Nice.
But yeah, and then finally, just we're gonna have a new idea on the housing side. We're gonna talk about that one tomorrow.
Well, all right. It was just a teaser. All right. Good. Excellent. Thanks, man. All right, we'll keep it moving then. Thanks. Jay, you on?
RPK, it's Jack this morning. You'll get another teaser from me today. So we're just grinding away on our building products and HVAC deck, which we're hosting today at 2 p.m. So we'll be going over names like Owens Corning, Armstrong World Industries, Carrier, Lennox International, which actually has an investor day tomorrow. These are names that have underperformed after a tough couple of years with higher interest rates and poor building activity. But we think there's a nice entry point here, especially with a couple of names on signal strength. And we've got a number of upcoming catalysts, but I'll save those some of the specifics for later today at 2 p.m.
I mean, these were darlings for years, but prior to that, I mean, every quality compounder, I just buy quality company investors just owned these things without like any without doing anything, right? They maybe checked in on the calls, and so yeah, it's interesting to see how much they've been kind of underperforming the last couple of years. So yeah, that'll be good stuff. All right, we'll tune in. Excellent. Fernando, you on?
I'm on RPK. For what it's worth, I bought a Lennox AC HVAC for my house a couple of years ago, so I contributed to those compounders' margins.
There you go. Where do they get you with the service? Yeah.
Well, obviously a lot going on in the oil and gas world. We're going to have a call today at 10 with JT and Scott Smithson to discuss Iran and the attacks. Probably the biggest highlight is there were attacks on the port of Fujairah in the UAE. That's a very important port because it bypasses the Strait of Hormuz for the UAE. It's between 1.5 and 2 million barrels a day of capacity for the UAE. So about just under half of what the UAE produces can be moved away from the Strait of Hormuz. Aramco as well has been hit. The Ras Laffan refinery was hit. It's a 500,000 barrels a day refinery. It's likely been shut down. Refineries are the highest risk asset within oil and gas. So if there is any kind of hit, you typically shut the whole thing down at first. And Saudi itself only has about 5 million barrels out of 9.5 million that they produce that they can bypass by going to Jeddah on the Red Sea on the East-West pipeline. That can also become a target for the Iranians. We'll have to see if they manage to attack that pipeline. But certainly, some of the events that are taking Brent now above $83 per barrel. Again, so far the indications are shorter term. If this does prolong for several months, we expect to see releases from strategic petroleum reserves in China and the US, which are the largest ones, to help tamper down the price a little bit. But this could be very beneficial to a lot of our long calls, especially oil E&Ps. I highlighted Diamondback, Fang, and Matador MTDR on the call yesterday. The majors also benefit, but again, I'll highlight Exxon, XOM, Shell, SAGL, Total, TTE, and Conoco, COP all have exposure to Qatar. BP has exposure to Abu Dhabi. So they have more direct exposure to the conflict, negative exposure to the conflict, which is more than offset by their non-Middle East production. But nonetheless, they are not going to be as clear beneficiary as the U.S. E&Ps.
Yeah, I mean the higher beta play, right, is the way to play the onshore domestic, for sure.
Yeah, absolutely. The refiners are also catching a bid because obviously there's closure of refining capacity, and you do get demand, especially for diesel when there's war. I think there's potentially less of a read-through here for them because there would be less necessarily import markets right now, less transit also. But we'll see if that, I think the Gulf Coast refiners benefit more than, for example, the East Coast refiners that usually import crude from other parts of the world.
Yeah. What's thoughts on LNG too? I mean, I guess I want to touch on that because I know there was an attack on a Qatari LNG facility that did suffer some damage, and I don't know if we know the extent of how much the damage there is yet, if the trains are actually damaged or if it was just something that couldn't be
It was
fixed
one of the
relatively
power
quickly.
plants.
Okay.
One of the power plants at the facility.
So far, anyway.
Yeah. But they did close the stop LNG production on one of the trains. Again, that's where Exxon, Shell, Total, and Conoco have their most exposure in the Middle East. Certainly a big impact for LNG as well. The Qataris are the second largest exporter after the US of LNG. So it helps. But I'll remind that most LNG is contracted and the US players have liquefaction fees. The one difference here is Venture Global that has their commissioning cargoes that are more spot market, not exactly spot market, but spot market. BP and Shell and Exxon have large LNG trading. But the problem is both of them, especially Shell and Exxon, have lost equity cargoes. So the cargoes they actually own are now not getting produced. So they can trade some of their other positions like Wheatstone in Australia or Papua New Guinea, and that will gain. But for Exxon, Qatar LNG could have been as much as 15% of net income at times. So it's a very significant loss. Again, mitigated by other parts, but it's not, especially on the LNG side, they're not a huge winner. On the oil side, they're a huge winner. On the LNG side, they're kind of slight winners.
Well, but I guess one question I would have is, does either LNG or venture have capacity they were looking to contract, right? Or are they fully contracted right now?
So Cheniere, which is ticker LNG, is primarily all contracted.
Right. Yeah.
And then Venture, they do what's known as commissioning cargoes at Plaquemines, which is their newest uh, project. So those are usually in 1 to 6 month contracts. So they will be able to recontract some of those. But again, that was also why they were sued, was those commissioning cargoes.
All right. Fair enough. Anything else this morning?
That's it. We'll have that call again at 10 a.m. with JT.
All right. Excellent. Thanks. Let's move to Friedman. You on?
Yep. Morning, sir.
Morning.
Let's see. I guess I just call out that, the ad market is notoriously sensitive to geopolitical events. Now, at least historically, we've been less sensitive. Just, I guess it's a good or bad thing where brands are just maybe a little bit more immune to what's going on. But I think that if we're in a situation of like a prolonged event here, that eventually it will distract the consumer. Historically, we do see some negative retrenchment or pullback in brand spending specifically. So we just have to, keep an eye on it. Again, especially if gas prices start going up. I know it was talked about earlier, but like historically, like the number one impact on e-commerce spending and direct-to-consumer spending, and therefore impacting digital advertising spend for Meta, Google, Pinterest, everybody else. It's when gas prices start going up, the consumer starts pulling back a little bit on the margin, and that has an impact on ad spend. So something we have to watch very closely, because last year, we did see a pullback at the end of February through early April in the ad market. Part of it had to do with, Liberation Day impacts. But, if we're going to comp that easy comp and have with this added headwind, then, we could actually maybe slow on a 2-year basis, right? Which wouldn't be great relative to expectations. So we're going to, do an update as we always do in a week or so, just kind of going through the ad market, the data, the trends, what the field notes say. So just wanted to put that on everyone's radar.
Is that just ask a quick question on that? So is that just the mechanism being that they pull back on spending because they're anticipating there's a slowdown, and so there'll be less ROI on the spending, so they want to save their budget for later? Is that sort of
there's an element of that. I mean, so like you have your brand spending, right? And you have your performance marketing. The brands and direct response brand spending is going to be a pullback because they don't want their brand associated with global conflict, right? Like if you're advertising on TV and that gets distributed on CNN, you don't want like, the golden arches or Chili's logo like next to a picture of like bombs dropping,
yeah,
right? So
right.
there's like a brand safety element of that. And that tends to be a little bit more sensitive. And then the direct response piece, it's actually it's pretty much coincident with, right? Or sometimes in response to. So it's not really cutting performance marketing spend in anticipation of, which is why I said that, if we do see kind of a distracted consumer, right, because of what's going on, that has a behavioral impact in terms of conversion rates, right? People are just a little bit more cautious, so they don't convert as fast, or we're going to have a purchase and they may be delayed by a week or two. Or you have, rising gas prices, which starts to eat into discretionary spending in real time, right? And so it's usually coincident and to like 2 weeks to 1 month lag, depending on the brand, but more sensitive for smaller brands, right? So it does happen in fairly real time, which is why I think we'd see it in the data, which is what we've seen historically. But it's still, given that it just happened over the weekend, it's still too early. I'd say we wouldn't know for sure for like a week or two, which is when we're going to have an update. So hopefully that answered your question on that.
No, that's good.
And just quickly on Pinterest. So, obviously this one's underperformed. It's put in the bucket of, ad software stocks that are down 50% year to date or were. Elliott is still involved, and if there was any doubt if they were still involved, that got put to bed this morning because they announced a $1 billion strategic investment from Elliott, and then an accelerated stock repurchase of $2 billion. So that's effectively combined like almost 30% of the float that they're buying back here. Now there is some convertible debt issuance that I have to look a little bit closer into. It looks like the conversion price on that's about a 30% premium in the low 20s. But they'll manage the dilution on that, I think pretty well. So look, I mean, like the point here is that, there are a group of stocks. We've been seeing this theme where they're down a lot. They have a lot of cash, right? Like you're sitting there with like 30, 40, 50% of your market cap in cash. And yeah, the business isn't performing well, but the core fundamentals, in the case of Pinterest, being engagement, right, which matters a lot, is still growing and accelerating. So they just have to figure out the monetization mechanism, of course. But I think from a strategic value standpoint, meaning like if they were to actually sell themselves, that actually is really, really attractive, right? Because they have a large, high commercially intent user base that's growing and engagement and growing search activity on the platform. So just something to, an event this morning to pay attention to. Obviously gonna be impacted by any macro. And they have some issues that they have to figure out on the monetization piece, like I mentioned. But to the extent that this thing starts to get back to bullish trade and trend and acting a little bit better, and we get easier comps in the back half of the year, with 30% shares removed, I'll just something to just keep on your radar. That's all.
Yeah, have they made? I mean, I haven't been following this story very closely. I mean, the big bull case back a few years ago was like they're under monetized relative to other platforms. Like, where are we? How did they end up? Did that end up not panning out? Is that like? I guess I'm kind of like.
It was mostly an international story, right?
Yeah.
And that's continued to play out really well. I mean, the last year, the international ad business was growing, like 40, 50%. It's really just the US business, the UCAN business that's been slowing the most. And that's what's slowing to like mid-single digits. And that's largely because of their exposure to, certain retail categories that are getting pressured from tariff activity. So that's a big part of it. They brought in somebody as their chief revenue officer at the end of last year, who's like, I've done a bunch of checks on him. He's super aggressive. So, to kind of give you a sense on, what they're thinking about and trying to turn this around. But my view, RPK, honest, like candidly, and just on like this mid cap internet names, is that it's really hard to be like anything of like be real owners of them, right? Like they're always going to be more rentals, like based on rate of change, because Pinterest is just never going to be a globally scaled ad platform. Like so
That makes sense. All right, good. Anything else this morning?
No, not unless if you have anything that. I mean, MongoDB blew up. I mean, yeah. I mean, you and I talked about that one.
What's that one?
The Mongo. The Mongo.
There are so many software narratives out there, and now you got everybody, not us, but I mean, like even this conversation that you guys are having. I mean, if Pinterest or any stock doesn't show revenue acceleration, like you can blame war, you can blame AI, you can blame Trump, you can blame whoever you need to be, but I would just blame your lack of ability to model the company properly, right? A revenue deceleration is a revenue deceleration. Why cyclicals are beating software is primarily that.
Yep.
We've shown this extensively in the macro deck. So if you can show like Coherent yesterday, right, RPK? I mean, I don't know if I'm allowed to say it was a huge winner for Sam, but I just did. I actually forget if you own that one too, but I mean, it's like, so COHR, you see that move yesterday, like Freebird, that one, like up 14% because they printed a revenue acceleration guide to one. I mean, if you're long Coherent and short Mongo.monkey.bomb or whatever the hell that thing is, you're the smartest investor in software. You should charge $5 and $50. I mean,
Instead,
Yeah,
what's
I mean,
happening is
to
you
be
get all
fair,
these
to be fair, I don't think
all
that
these
I don't think
people are
that's a
just like
software. I don't think that's
lamenting.
yeah.
Well, whatever
Yeah.
it is. Okay,
Yeah.
you're
It's in tech.
you pick stocks. You pick exciting stocks. Whatever the fuck it is that you do. If every day you got on CNBC for the last 2 weeks and said, I'm buying Coherent, I'm shorting Mongo.bomb, you're the fucking smartest guy to ever be on CNBC. Okay? That it's like these are not the things people are talking about. What they're talking about is getting smoked together, right? That is identifiably a backward looking bubble in software stocks. Bitcoin, it's all the same thing back to October. A little fired up about it because I still find that, and I need people that are new to watching this morning, which there are many, to know that there's so much better way. I mean, Friedman has this number of software longs on his active long list. 0, right? So
Yeah, I mean that's intentional, right? I mean, because like, look, I mean, to your point, Keith, like you're absolutely right on the pods, right? And that's a it's like the signal to the quads to the pods, like it all rhymes for a reason. The point here is that like with Mongo, like they guided to a deceleration. This is a stock that had outperformed broader software for the last 6 to 9 months, and positioning also reflected that as well. And because the business was accelerating, and because they had perceived real or otherwise, they were an AI winner, right? And so then what happens? They come out, and whether or not you believe that they guided conservatively, which they likely did, right? But doesn't matter, right? Like it was still extended on a relative basis to the peer group. It had outperformed, and they guided to a decel for Q1 and a decel for the full fiscal year relative to its exit rate. And that's just not going to cut it in this market, especially. So, from here, what we have to do is we have to pay attention to the data. We have to pay attention to the fundamentals, and we have to pay attention to the signal, right? And when the signal starts indicating that, something's changing, and the fundamentals and our model and our ability to model also, align with that, that's when, things get back to bullish trend. And that's when you can really lean into things with high confidence and that it's going to start working, right? So, we'll see what happens on this one, going forward. But I'm with you 100% on that. And the same thing with Pinterest, right? Like they guided to a deceleration in Q1, right? Like the stock and this was trading like that. The signal was saying that something is wrong, and that's exactly what happened. And then the question, just like I said and you said from here, right, is going to be who cares about your buyback if the business continues to decelerate? So we just have to wait for the signal to start to turn, and then see if we can get confirmation in the data. And again, if the pods start to accelerate. So I think I just said like, the 3 things all like 3 different times, but I think it's important.
Yeah, there you go. Get a possible why. We'll wait and see if we get a win. All right. Awesome. Let's keep moving because I'm mindful of time. So I think there's no Felix today. So
we have no Felix today. Yeah.
Yeah. All right. So great. Let's move to Paul. You on?
Yeah. Good morning. So as you know, there's that social media addiction trial going on against Meta, Facebook, Instagram, TikTok, and others. And there's a decision from the state court in Delaware. And it will be appealed, no doubt, but that the insurance companies who provide liability insurance to Meta platforms are not obligated to cover here. Because what's being alleged there is deliberate design of a platform to addict young users as opposed to a negligence case. And so they'll fight it and they'll appeal it, but it just underscores the liability overhang risk on this company as this case proceeds through the bellwether trials. Remember, there's also a big multi-district case involving thousands of claims as well in a federal court that will begin its bellwether trials in June. So this is just raises the potential liability overhang risk for the company. So that's it for me.
All right. Thank you. That'd be a topic we can pick up for another day. Let's get to JT.
Yeah. And Paul, I know we're out of time, but what happened? Didn't the federal appeals court decline to implement Trump's the refund process? Isn't that going to move forward now?
Well, no. It's I don't think they're going to stay that. So
they're not going to stay it, correct?
They're not going to stay it. So that goes through the Court of International Trade, and that process begins. And we'll just have to see what the government files there, because they don't want to go to the refund process right here. And so
we're looking at that refund process starting the legal process starting sooner than later, right?
Yeah, they'd like to delay it, and
Yep.
it's not being delayed. So, but they can file in the Court of International Trade to try to slow it down there. They're just trying to stay everything at the appellate level. They did not get that. Yeah.
Got it. Hey, RPK, obviously out of time. A lot going on in Iran. This is in terms of a lightning strike or a quick hit. It looks as if this is not going to be that. That we're looking at something with a much longer duration. Trump keeps talking about 4 or 5 weeks right now. A big wave is coming. I mean, there's so much on wrap. I think you left the call Friday. So many questions. There's still so many questions that need to be answered. We are going to try to do that in a couple of. We had McCausland yesterday. We're going to have Smithson and of course Fernando today at 10. We're going to do a couple of segments here over the course of this conflict to try to cover as much ground as we can. So they will be, of course, focused on energy, short term, the Straits of Hormuz, LNG, and we'll just save it for that at 10 o'clock today.
Hey, RPK, before we wind up here, I just have 3 minutes before I get to the office. So I want to get something out of it other than losing my precious life and cycle time listening to the radio. I just had a call with one of our big Middle Eastern clients. Like, that's where they're at. They're doing the call. They're all in their houses doing it remotely because obviously there's plenty of risks to be managed there. But they're like, the Western media is completely blowing this out of proportion relative to what life is like living here right now. It's not that bad. Like, I mean, they had no, like, it's not like this is just a, like private conversation. So, I mean, I was like, oh, that's shocking, right? I mean, it's like, if you turn on CNN right now, you may be given the message that you may not be alive tomorrow. Like, the world is ending. We're right back to that. I mean, it's like we're positioned properly for today. We're short everything that most people are long. Tech, consumer discretionary, shitcoin, etc. And at some point, I'll call it Bitcoin again when I get bullish on it, right? But if there is a time, like today is definitely very newsy. RPK, I just wondered if you had any thoughts on that in terms of like, we're indoctrinated by old wall. It's media. It's bullshit.
Yeah, no.
Today's the day.
Yeah, I mean, boy.
Hey, Keith, it's Sam.
Go ahead, Sam.
Just want to jump in quick. I have a couple of contacts there, and I absolutely agree with what you said. Based on what I heard from them, it's like it's as close to business as usual in terms of activity in stores and traffic on the roads, despite obviously all the Twitter bear porn that we're getting every day.
Okay,
yeah, I mean,
that's good.
That's kind of my point of my X post this morning, which is that when everyone starts having an opinion about this, I think you said this yesterday, Keith, which is exactly everyone's become an expert all of a sudden on this topic, right? Like today everyone crammed for the exam overnight, and now they know everything about what's going on with all of the conflict in Iran. Well, it's a complex multivariate world. Very little. Even the most knowledgeable people don't know everything. All the way, and that goes all the way to the top. Even the people running this operation don't know all of it. There's things that they don't know. So I just be humble and be and just watch and be mindful of the sentiment, because I agree. If you turn on the TV, they be mindful of their monetization model, right? They want engagement. They want you tuned in because they want you either outraged or frightened most of the time. So let's just keep our heads straight and just
to use a basic example, like if you thought that this was going to be what JT just, which is probably what he's going to comment on, if you thought that this was just going to be in and out, and you thought oil was going to go to 75 and back, or 72 and back off, you had it wrong. The insiders knew that it was going to be 4 to 5 weeks. Okay, now it's taken to 77, 78, 80. If you're talking about Brent oil, 86. When everyone knows RPK, it's already in the fucking price. I mean, that's the point, right?
Yep.
Like we just got paid on that. So I don't want to, like, us of all people, like if I was another type of person with no integrity and no moral compass, like I worked at CNBC, I would be pumping the shit out of oil right now because I'm so long of it in oil stocks. That's not what I'm saying. I'm saying, like, don't get like greedy here. This is going to get to a place where it's extremely overbought on extremely, wayward and ongoing MSM media here in the U.S. that is so far shot itself that you couldn't make it up if you tried. JT wanted to say something else.
Yeah, that just one person that isn't cramming is our speaker today, and we've had him on before, and he did play a significant role at DoD in the past at CENTCOM, specifically with Iran. So he's got a deep experience and knowledge there. So we're looking forward to that insight today. So he'll be with. He's been with us in the past. He's on a number of calls with me and Fernando, and he's going to be here throughout the conflict. And again, we're going to do a quick 20-minute hit today. Check out his bio.
Excellent. All right. Excellent. I think that's it. So we'll wrap it up there. Thanks for joining the call, and anyone who's been joining us for this free week. Great. This is a good introduction, and please tune in again tomorrow. Thanks, everybody. Good luck out there.